Hey everyone, Couch Investor back with the second video of the night. We already covered Roku. If you want to check that out, it's going to be in the top right corner. Now in this video, we're going to cover the infamous Teladoc. Now the good news is it beats on earnings per share and on revenue consensus. And there is no one-time, well, it's no one-time goodwill charge, impairment charges, but there is none of that in this quarter, which congratulations. But overall, right now, I believe the stock is up around 4 to 5% when I'm filming this. Again, it doesn't mean anything. Doesn't mean anything these days. It can be up after hours, then there's the earnings call, and then the market opens and you're red. Or the opposite can happen as well. So let's have a look at what actually happened during this quarter. So first up, let's start here with a little comment from the CEO. So Teladoc Health delivered strong first quarter results across all key financial and operating metrics to start the year. With a strong financial position, we are able to fund and invest in innovations and a world-class team of medical professionals as we support leading employers, health plan, hospital systems, and governments around the world. We have solid momentum heading into the rest of the year as the market embraces Teladoc Health's unified whole person care experience. I think the last sentence here shows a bit of confidence, let's say, about the state of the business. Now, that doesn't mean that suddenly it's printing cash left, right, and center. No, far from it. But maybe we are finally heading into the right direction. Maybe all the hits have been, let's say, received. And now we can finally move forward. So we're going to have a look at all of that in this video. If you enjoy this type of videos, leave it a thumbs up. Subscribe if you have not. I would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. And thank you to everyone that is supporting this channel through other, options, membership, merch, you name it. Thank you very much. I really appreciate you all. All right, so let's start with revenue. That's up 11% year over year to $629 million. Adjusted EBITDA, I believe, is down around, 3% or so, $52.8 million there. Okay, let's see how they can perform on the full year. I will already reveal the secret here. They did update full year guidance. A bit more positive, not by much, but hey, we'll take it, I guess. Then integrated care segments revenue, quarter over quarter it's down, year over year we're up, $350 million there. BetterHelp segment revenue is up year over year and quarter over quarter, $279 million. Not surprised there, to be honest, but when you look at the adjusted EBITDA here, it's down significantly quarter over quarter. We're now at $18 million. It's also down year over year quite a lot. Then integrated core segment adjusted EBITDA, down quarter over quarter to $35 million, but up from $23 million in the same quarter last year. And for those that don't know the difference between both of it, the BetterHelp is BetterHelp. And then the integrated care, they say it right here, integrated care segment includes a suite of global virtual medical services, including general medical, expert medical services, specialty medical, chronic condition management, mental health, and enabling technologies and enterprise telehealth solutions for hospitals and health systems. Now, as for the mix of revenue, US revenue still the majority, no surprise there, $542 million, and international revenue, $88 million. Both of them have increased year over year. Now, as for some key operating metrics, so US integrated care members were now at 84.9 million, an increase year over year and quarter over quarter. Average revenue per US integrated care member, that's actually down quarter over quarter and year over year to $1.39. Not that great, if we're being honest. Anyways, going further here, BetterHelp paying users, that has increased to 467,000. Chronic care program enrollment in thousands as well, so just over 1 million. And of course, if you're not monetizing as well anymore, some of the results is, leading towards this. So gross margin and adjusted gross margin are down quarter over quarter. Of course, they're up year over year because, last year was a complete disaster, but still we're back down here. Adjusted gross margin back, a bit under 70%. When you look at GAAP gross margin, we're at 67.8%, which is the lowest we've been since after Q1 2022. So again, not really the direction you want it to go. Especially not since they promise that margins are getting better and better, which we know, of course. Yes, adjusted gross margin have become a bit better quarter after quarter, and Q1 for now not, but overall it has been very, very slow. And then when you look at adjusted EBITDA and adjusted gross margin here, you can clearly see the difference again from Q4 to Q1. Okay, Q4 was a one-time thing, so you had that huge increase in adjusted EBITDA and a 14.8% adjusted EBITDA margin. But right now we're back, let's say, at the levels we were at Q3 of 2022 and under the level of the same quarter in 2022. So again, not great. But as they said in that comment at the start, they have cash to invest and operate their business, cash and cash equivalents of $888 million, convertible and long-term debt on balance sheet $1.54 billion. Then operating cash flow $13 million. I believe it's $13.2 million or so. So, okay, there is some operating cash flow from that business. Good to know. Capital expenditures and capitalized software development costs for this quarter, $46 million. Now, another thing here, before we go into the outlook, is stock-based compensation. As you can see, it has been decreasing quarter after quarter. We're down to 46 million. That's down from 50 million in Q4 and down from 60 million in Q1. So this is, to me, a big positive. Now, as for outlook for Q2, they expect revenue to grow between 7 to 11% year over year. Net loss per share to come at, well, a loss of 55 to 45 cents. Adjusted EBITDA between 60 to 68 million dollars, and US integrated care members between 84.5 and 85.5 million, which is a bit of the same for the full year. So that's a year-over-year growth for Q2 of 5 to 6%, and for the full year 1 to 3%. Now, of course, if you look at revenue and the rest, basically it's far from their own guidance. I believe it was 1 year ago, 1.5 years ago or so. The average guidance, the CAGR actually, for until 2025, 2026 or so, which was much higher than this, nowhere near that right now. Now, as for the full year, they expect to grow the same between 7 to 11% year over year. But yes, we see here a little updated guidance, a bit on the upside when you look at the lower end here. Okay, fine, we'll give them that. Now, net loss per share, still a loss here, $1.70 to $1.25. Okay, then adjusted EBITDA, that will grow 16 to 32% year over year. And of course, for Q2, that will grow between 28 to 46%. So a big gap there. But if they can come, let's say, towards the higher end of their estimation, I think the market will be pleased. So to conclude, even though the stock is up 5.43% at the second I'm filming this video, let's be honest, this wasn't such a great quarter. But because the bar has been set so low, I think the numbers we're seeing right now are like, okay, right, the company is not doing worse than it did the last quarter, let's say, or they're not losing as much money as we feared. If that's enough for it to be up, let's say tomorrow when the market opens, okay, fine by me. But I think there's still a long way to go for Teladoc to, let's say, gain the confidence of the overall market, but especially from its shareholders. I think management has still a lot of work to do to regain the trust of the market and shareholders. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.